We had some great questions roll in during our last webinar on real estate investing, and we didn't get to them all. So today we're circling back. One thing we're passionate about here is keeping our audience informed, especially when it comes to building wealth through real estate. If you've got more questions after this video, drop them in the comments or send us an email and we'll be sure to give them answered. The first question is, what kind of tax planning can be done to mitigate paying back the depreciation once the asset is sold? To reduce or avoid paying back depreciation when you sell a property, one smart move is to use a 1031 exchange if you have not done a cost segregation. This lets you roll profits into a new property and defer taxes, including a depreciation recapture. If you hold on to the property until you pass away, your heirs will get a step up in basis, which wipes out depreciation recapture altogether. Some people use a charitable remainder trust to sell the asset, which can significantly reduce or defer taxes while also supporting a good cause. Planning ahead with a tax advisor makes a big difference here. If you did a cost segregation, you need to manage your time so that you can manage depreciation recapture on non-real estate assets that you segregated. A 1031 exchange or installment sale will not help you with this recapture. Next question, what's the best legal structure to do this investment under? One LLC for all properties, one for each property, doesn't matter. The best structure depends on your goals: liability protection, tax efficiency, and ease of management. You can hold all of your properties under one LLC if you want simplicity and lower costs. But the downside is risk. If one property gets sued, all of the others in that LLC are exposed. Using one LLC per property provides stronger liability protection and makes it easier to sell individual properties or bring in partners. However, it can get expensive and more complex, especially with multiple tax filings. For taxes, all LLCs can be structured the same way, usually as disregarded entities or pass-throughs. So the main issue is risk management, not tax differences. Many investors use a parent LLC with multiple property LLCs underneath to balance protection and organization. In rental real estate, LLCs will not save you any taxes. Next question, I earn $600,000 a year and I need to buy a property worth $2.2 million to save in taxes. I'm so confused. Buying a $2.2 million property will not automatically bring your taxes to zero. But if it's a rental property, you might use bonus depreciation to offset your income. If you do a cost segregation study, you might be able to write off a big chunk, say $500,000 to $700,000 of that property in the first year. If you qualify as a real estate professional or you meet material participation rules, like the short-term rental loophole, you could use that big depreciation to offset that $600,000 income. So yes, with the right setup, it's possible to wipe out most of your taxes, but it depends on your situation, timing, and how active you are with your rental. A tax pro can help fine-tune this strategy. Question 4. So I need to invest $2.2 million or just the cost and most of it can come from a loan? This makes sense for someone in the 37% tax bracket. How effective is this for someone making $200,000 married filing joint? You don't need to personally put in $2.2 million. You can finance most of it with a loan. What matters for tax purposes is the purchase price, not how much cash you put in. The full $2.2 million can still generate the depreciation based on the full amount. For someone making $200,000 married filing jointly, the tax savings might not be as dramatic unless they can actively use the losses. Suppose you or your spouse qualify as a real estate professional or meet material participation rules, especially with short-term rentals. In that case, you can still use depreciation to offset your W-2 or business income. Otherwise, those losses may be suspended or carried forward for future years. Still helpful, just not as immediate as for someone in the higher tax bracket. What will happen if I sell the property next year? If you sell the property the following year, you'll likely face depreciation recapture or capital gains tax. The IRS will want back a portion of the tax savings from bonus depreciation through recapture. Plus, if the property sells for more than your adjusted basis, you'll owe capital gains tax. short-term at your regular income rate if held under a year, or long-term 15 to 20% if held more than a year. So while you get a big upfront tax break, selling too soon means a lot if it could be clawed back. This strategy works best if you hold on to the property longer. If you did cost seg, you can manage your depreciation holding on to it longer. Question 6, the problem is if I buy a $500,000 property, will I not be cash strapped, paying a mortgage in the upcoming years? Yes, you could be cash strapped. Even with tax savings, a $500,000 property may cost $3,500 to $4,500 a month. And if the rent doesn't cover that, then you will need extra cash. While tax breaks can ease the burden in the short term, they won't make a bad investment good. Always prioritize buying a cash flowing property first. Tax advantages should be a bonus, not a foundation. Question 7, what is the bonus depreciation for 2025? Is there an update on the bill to make bonus depreciation 100% again, especially for short-term rental strategy? Bonus depreciation is set at 40% for 2025. There is ongoing discussion about reinstating 100% bonus depreciation from the administration, but nothing is passed yet. The short-term rental loophole, where you use depreciation to offset your W-2 income if you materially participate, still works, but it's less powerful now due to the lower depreciation rate and higher interest rates. It worked best when rates were around 2%. If 100% depreciation comes back, it could be a strong strategy again. For now, plan with 40%. Does bonus depreciation apply for states as well, specifically for Massachusetts? Bonus depreciation is a federal tax benefit. Most states, including Massachusetts, do not conform or require you to add it back when calculating state income. So you'll likely see no tax savings from bonus depreciation. What are the limitations for a cost segregation study? If I have a rental property but no real estate professional status and I'm not materially participating, can I still do it? Yes, you can still do a cost segregation study and claim depreciation. But without rep status or materially participating, those losses will be passive. You can only offset passive income, not W-2 or business income, unless you're using short-term rental rules. Question 10, rep status is hard to get. How do you get this with the W-2 income? Are we using the Airbnb loophole? Correct. If you have W-2 income, it's hard to qualify for real estate professional status. However, with short-term rentals, the Airbnb loophole lets you skip rep rules if you materially participate. And average stays are under 7 days. Question 11, after buying 9 doors, struggling with a 25% down payment, how do you handle it once you max out the conventional loan limit? Investors often use creative financing, like partnerships, seller financing, HELOCs, or DSCR loans, capital from cost segregation tax savings, or 1031 proceeds to help cover future deals. Question 12, should I max out my HELOC and buy one big 10 to 15 unit property or 2 small 3-unit properties? From a tax perspective, both get depreciation, but larger properties may offer more bonus depreciation through cost segregation. The key is whether cash flow and tax strategy align. Bigger properties can also simplify management and scale faster. What are short-term rental and long-term rental differences in strategy? If you materially participate, short-term rentals can let you bypass the real estate professional rules. That means you can offset your W-2 income with depreciation. Long-term rentals typically generate passive losses unless you're a real estate professional. How does this work if I have a partnership buying a property? Same tax benefits apply, but depreciation and losses are split among partners. Your ability to use losses depends on your individual tax profile, whether you're active, passive, or qualify for real estate professional or short-term rental rules. Any numbers on the savings with normal depreciation schedule? On my $2 million property, standard straight line depreciation gives about $72,000 a year, ignoring land value. If you're in a 37% tax bracket, that's roughly $26,000 a year in tax savings. If I own and manage my own property, how can I make it non-passive? To make it non-passive, you must materially participate. That means 500 hours plus a year or doing most of the work. There are 6 other tests. 500 hours is the golden rule. For short-term rentals, average stay 7 days or less with material participation also makes it non-passive without even real estate professional status. Is this still a good strategy given the high interest rate? Tax-wise, yes, the strategy remains strong. You still benefit from depreciation and other deductions that can offset your rental income. However, higher interest rates can significantly reduce your monthly cash flow, impacting your real return. Make sure you run the numbers carefully to ensure the property still performs well. And remember, today's rates aren't forever. You can always refinance when rates drop. How can I buy a property every year if I'm cash strapped from mortgages? Leverage tax savings from cost segregation to free up cash. Also, consider partnering, using DSCR loans, or reinvesting with 1031 exchange. Creative financing is key. How can we use the same investments as an LP and syndications? If you are a real estate professional, you can use limited partnership losses just as your own rental. If you plan your real estate professional status correctly, limited partners can get passive losses passed through, including bonus depreciation. If you have other passive income, it can offset that, but you can't use it against your W-2 unless you're active in the deal. If I save $161,000 in taxes on W-2 income, do I get that refunded from the IRS? Yes, if you overpaid through withholding and your return shows $161,000 overpayment, you'll get a refund. Otherwise, it reduces what you owe. The tax savings show up at filing time. What's the best legal structure? One LLC for all properties or one per property? For taxes, both are the same, but for liability protection, one per property is safer. Many use a parent LLC that owns multiple single property LLCs to balance protection and simplicity. That's all of our questions for this session. Again, if you have any more, please drop them in our comments or send us an email. And be sure to join our next webinar. That will be on entity structuring. We always get a bunch of questions on that. So we will be answering all of your questions on the next webinar as well. We love keeping you up to date. Be sure to follow us on social media. Also, be sure to look out for our weekly newsletter or sign up if you haven't already, where we share updates in the tax world and more.